Welcome back. With many local and international companies expanding into Africa and enormous hype around the investment potential in developing countries, Africa seems like a great investment destination. But ReCM cautions investors against catching the Africa fever. Today we're here to discuss the potential pitfalls of Africa as an investment destination. We've got Simon Reid, head of Imara Africa Securities, joining us in studio here, and joining us from Cape Town, Linda Eedes, a senior analyst at ReCM. So I'm going to start off with Simon firstly, because Simon, that's what you do. You look at Africa, you've been investing in Africa for so long. We've been talking about Africa here at CNBC Africa, tracking development of the stock markets, and certainly there has been massive modernization. So are things better right now than they say were 5 years ago?
Oh no, they're materially better than they were 5 years ago. Where we stand today, there are only two markets left that are still paper-driven, which are Malawi and Zimbabwe, and I think it's pretty obvious in both of those cases with the economic and governance issues that they've had over the last few years, why they haven't progressed like all the others. But all of the other markets are now, they've got electronic depositories, so share certificates have disappeared, and all of the benefits of that have come to all of those markets now.
So what's the biggest pitfall you found? Is there one or there are few?
No, there's one, and in a nutshell, it's cost. The cost associated with going into frontier are always going to be something that experienced investors in say the South African market or Western markets just won't understand the cost profile. Obviously the biggest part of the cost is largely in the custodial process, and it's very difficult to educate custodial banks as to the advantages of getting costs down so they can get throughput up. Mm-hmm. They don't really understand that kind of business as we do trading in exchanges.
What about the depth of the actual markets themselves, though? I mean, we've seen Deutsche Bank put out products in the last 2 years, Standard Bank, they've given ETN type products that can give you a tracking capability, but they can't take a mountain of money and suddenly be able to invest it across the continent into a lot of these markets, because there's plenty of opportunities, but the depth of the capital markets don't appear to be there.
That's true, but everybody's got to start somewhere, and the good news about these domestic markets is that the domestic savings industries in all of them are growing now exponentially. So you've got government pension funds now more and more being outsourced to the private sector. So the growth of domestic savings is going, and that will deepen those markets in a very big way. And it'll happen quicker than you think. In 5 years' time, we're going to be looking at a materially different landscape.
Yeah, even already just looking at some of the volumes across key markets, Nigeria and Kenya, they've come up quite dramatically. But Linda, of course, has a different perspective for us. And we're trying not to catch the Africa fever. It's hard not to when you see the growth rates of some of the countries, Linda, when you see earnings coming out of companies where you see earnings up by 50% and the like. But why do you caution against African investing?
Well, at ReCM, regarding capital management, we are value investors. And what that means is that we want to stack the odds in our favor of generating good returns for investors by buying securities when they're trading substantially below what we believe they're worth. Now, when you have a very popular investment destination or a theme or a story that has captured the market's attention, the likelihood of prices being substantially below what things are worth is very low. And that's one of the major issues that we have with Africa, is this proliferation of funds being launched, ETFs, and sort of businesses trying to access that growth story. We think a lot of that is priced in the stock, and looking at retrospective performance, expecting that going forward, when that's unlikely to be the case.
Linda, if you only have a look at, say, Nigeria, a lot of the stock, because there's not a huge participation in the equity market at the moment, a lot of the stocks trade on single-digit price-to-earnings multiples. Surely that in the long term suggests that there is going to be value there. It'd be hard to argue that a lot of big Nigerian companies that are sitting on P's 5, 6, 7, 8 are not undervalued in the long run.
Well, Mark, the problem with Nigeria, the first thing that you already highlighted yourself, is Nigeria is the next biggest stock exchange in Africa outside of the JSE. And if you actually compare the market capitalization of the JSE, which is around $900 billion, and then you look at Nigeria, which is the next biggest, and that's sort of sitting at about $70 billion, there's a huge issue with liquidity and the trade volumes being substantially less, sort of 1/25th of what the South Africa Stock Exchange trades. Those earnings projections are based on forecasted economic growth rates. And there are two problems with economic growth rates being forecasted into the future. The first is that it's impossible to do it correctly and consistently. No one has yet been able to do that. And the second is that economic growth projections, even if they happen to be correct, which is unlikely to be the case, don't necessarily translate in the best investment returns for minority equity shareholders. Mm-hmm. So, these projected growth rates for Africa, what you've tended to find with regards to economic growth and share prices is that you actually have a negative correlation. The areas with the good economic growth that comes through tend to actually have disappointing equity returns because at that starting point, that's already priced into the market. Whereas those markets where the economic growth is not expected to be that good, often those prices are very low as a result, and the investment outcome as a result is actually good. And one only has to look at South Africa. I mean, we've had very pedestrian economic growth over the last decade, 15 years, and yet our market has performed very well. Mm-hmm. So, that correlation between projected economic growth is only valid if they're correct, and secondly, if the prices aren't materially reflecting rosy expectations on that side.
So Simon, I need you to come in here because if we're talking about Nigeria, you've got the consumer stocks there which are trading at very high PEs, but you've got the banks trading at very attractive PEs, certainly some of them. And there are some cheaper stocks which are considered blue chips. What's your experience right now? Because Africa has rallied quite hard. So I would beg to argue that there are still some gems out there, but are they harder to find, like Linda's saying?
Look, they are harder to find because your first filter is always going to be liquidity stroke market cap. But it's, again, when you try and pigeonhole the investment case, everybody's going to go and see different things. For a long-term investor, it's a very compelling story. Now, as a firm, we've got sells out on most of the consumer stocks out there, but you can't move away from the fact that Africa over the next 10 to 20 years is largely a consumer story. So when you've got long-term global funds out there, they will buy Nestle Nigeria, and they will keep on buying it on a PE of 40, which seems ridiculous even to us, because the demographic dividend that will come to a stock like that, given their experience globally. The one thing they've managed to do in Nigeria is sort out their distribution channel. Now, all they have to do is add products into a population going into the middle classes, and all they're gonna do is increase margin because they've got that distribution network all sorted out. And the distribution network is something that's not in the income statement or balance sheet.
Yeah.
And there's a lot of that going on across Africa.
And power also,
they're relatively unknown to the investing world, but that's why we're starting to see such anomalies come out in terms of valuations. Again, Nigerian banks, nobody trusts them, but all of them are on PEs of around 7, 8, 9, on dividend yields of between 4 and 7%. Who wouldn't want to own them? But it's carrying the discount that still hangs over from 2008, bearing in mind that a lot of those stocks are up 300% since 2008. So it depends on your investment timeline and how you're actually looking at what you want to achieve over that timeline.
Is it too simplistic just to say that Africa is going to get richer?
We use
the example of comparing the market caps of 700 billion versus 90 billion of the exchanges. At some point, capital comes back, the individual saves it, comes out of the government, typical government saving schemes, and comes into an equity market.
Africa's just getting dragged exactly where all the other continents before us over time have gone, including Asia. Capitalism is creating a brand new market regardless of politics. It is a long game, it's not a short one, but Africa is going to end up going down that road over the next 20 years, whether anybody likes it or not.
Just a quick one, Simon, what's the PE of Zimbabwe Stock Exchange right now?
It's about I think it's about 8.63 times.
I didn't want to put you on the step, but I know that's the stock you're very bullish on.
We are. It's obviously rallied a lot this year, especially the blue chip stocks. But we think that the story is still very good there. Zimbabwe's carrying a massive political discount. I don't really think that economically it matters what happens next Wednesday. It's anybody's guess what will happen. Clearly ZANU's lost support, but doesn't mean they're going to lose an election. But I think business is getting on with life anyway, and that the story is quite good after that. And you will see credit lines opening up into the country, and it's all going to go well.
So, Linda, what about Zimbabwe for you? Given, of course, it's very risky, but it's trading on a PE below 10, around 8 right now. Would that interest you? There are some blue chips there that are seen to be very, value offering right now.
You know, the issue is we did actually take a look at the African markets. We sent 2 analysts into various countries, such as Zimbabwe, for instance, and they came back and actually just reiterated our findings. That's not to say we don't have exposure to African assets, and this is the curious thing that I find, is that in our South African equity funds and even in our global funds, we're taking significant exposure to Africa in the form of investing in, for instance, the platinum miners, because the prices are so low and we're looking at the full capital cycle adjustment. And when I speak to investors about this, they ask the questions, you know, what about nationalization? What about government interference? What about, you know, all of these issues which plague emerging markets? And in the very same breath, they will then ask, you know, what are we looking at outside of South Africa in terms of African investments, where, you know, those risks are even more prevalent, one could argue, but the prices are far higher. Now, the thing that you have to differentiate between, and this comes back to sort of Simon's comment, is that there's a difference between the performance fundamentally that businesses may have going into those markets, expanding into those areas, whether it's organic or acquisitive, organic more preferable because they're likely to overpay for acquisitions, versus the performance that a shareholder will get paying the prices that you see today for stocks which already reflect very, very optimistic expectations. The businesses may do very well fundamentally, but we know that fundamental performance doesn't always translate into investment returns for shareholders, particularly when they've bought at high prices.